Sandeep Tandon joins in on the show right now to talk about what he's making of the market. Sandeep, hi, good morning. Great to have you on the show. And seems like, Sandeep, new highs are pretty much in store. We're practically there.
Is yes, but if you really look at the in terms of participation, it's completely missing. So the way I describe the market, the current environment market rallies are correct because the impact cost is on a higher side. Okay? If you look at the all three important participants of the market, like retail, which come through mutual fund or directly also, that remain relatively consistent. The flow has been slowed down, but has remained consistent. FIs has come back, which is a very good news. But if you look at the another important element, the HNIs or the family office, they are still not participate. They are very hesitant. So overall, if you really look at the the impact costs remain relatively on higher side. The breadth is also relatively weak, and that's the reason you are seeing the relatively more wild swings. But given the low leverage position in the market is obviously very, very light. So it has more legs to climb this key levels now.
That's a very, very interesting observation that you made there, Sandeep, and a couple of questions really from within that.
Yeah.
Firstly, what is keeping the HNI and family offices away? Because if you look at the cluster of stocks at 52-week highs within the NSE 500 or within the Nifty 50 as well, the list is not bad at all.
So what is really hurting them is about the negative news which is there. More you read about the global macro, the concern which is there, whether talking about de-dollarization or any other thesis, all possible negative news are there. Definitely, the global background is quite skeptical, because we track global macro very closely, and obviously anybody who's more educated and more inclined to track these market globally, they get more concerned. Okay, it's a very natural phenomena when you get surrounded with too much negativity and you understand the implication of these data points, then you are bound to be very cautious. So that's one reason they are very reluctant to participate. So since we try to capture both legs of the data, so we sometimes we see opportunity also. Like you look at today, also some of the stocks have corrected sharply. Since I talked about the impact cost, so sometimes the correction also gets over in a very short duration. Also, sometimes the correction gets over in intraday. Also, sometimes it gets over in 2-3 days time. Okay, so it's not like that corrections are sustaining for a few days or few weeks also. So that's the way I think the market is so dynamic. Okay, so if you can take advantage of these situation and play accordingly, then still there is some hope. Otherwise, a good amount of frustration is there despite we are closer to the 52 weeks high or all-time high.
The other observation also is, Sandeep, what you said about the fact that there is such less participation in the market also gives you confidence that at some point the FOMO feeling or the fear of missing out feeling will set in. And there will be a point when all these people who are right now sitting on the sidelines will jump into the markets. So suffice to say that at some point this year, perhaps now with interest rate trajectory at least stalling, both for the US and for us, that we would we could take out new highs as well, purely at an index level too.
So the phenomena of FOMO which you describe, I think the first people who are reluctant, they are watching global markets. So unless you see a sharp rally or recovery happening, particularly in the US market, which is the mother of all exchanges, unless you see a significantly up move, then the FOMO feeling will sink in here and people will chase. Till the time that is not happening, people will remain cautious. And I think as a house, we also believe that that is a risk of phase which started in January 2023, still continues. There's no signs of any data which showcase the risk of phase is over. But the good news is that global liquidity started inching up. And as we always talked about, the global tightening cycle, irrespective of what market believes, has actually peaked out in November or October 2022. So which is very, very positive development, which we can talk about. But I think it's a combination which we have to look at. So one should not look at the only few data points which suits your mood and then you take examples of those names or these examples. But my only point which I'm trying to highlight is that yes, market is close to all-time high, but there's many opportunity in small cap and mid cap space also. Certain sector rotation pieces are going around. If you can participate, keeping in mind it's a risk off environment. So one should not be very aggressive in terms of buying the high beta name. One should not be very aggressive in the very smaller names. Okay. So I think that will still take some more time unless breadth remain constructive for a few months. Then you will see participation going down to certain levels. Till the time, a cautious approach, but stock specific opportunity continues.
Since you're suggesting to stay away from high beta names, does it mean an avoid on all the Adani group of stocks as well?
So we don't want to comment on very group specific or stock specific. The only point which I said, since the risk of environment, we like to avoid high beta names or leverage corporate. So these are the cautious point which you have to take in the risk of it. If it's a risk on environment, these stocks deliver the best result. So if the cycle comes back in terms of risk on environment, we'll play through that also. But currently, I said that it's a bit risk of environment globally. India was very early to give that sign in January 2023 itself. So I like to be very cautious. Okay, that does not mean we are negative. We are definitely cautious and we are playing it safe. So in the current risk of environment, safety is first priority, liquidity is second priority. Okay, and then your returns come. So don't try to chase returns in this environment. It can be dangerous.
Sandeep, given that you have spoken of the risk-off phase continuing quite extensively, but at the same time saying that there is a lot of opportunity within the broader markets, keeping
Yeah.
safety as the utmost priority, where is it that you're seeing this opportunity?
So if you really look at from a safety perspective, some of the utility companies have done extremely well. Of late, you have seen FMCG or staple companies have done. This is a great area of safety. If you really look at in last 2 months or 1.5 months, Pharma has come back, which is another round of safety because it has reached those neglected and beaten down areas, which we typically try to look at. So there are certain areas, certain pockets which are attractive. So one has to keep on optimizing these names, and you will get opportunities.
Okay, utilities, pharma, those are some of the sectors as well that you're alluding to. But, just to take it back to that point, you were talking about a lot of concerns emanating from the global markets, and that really is what has been keeping the HNIs at bay. But given the fact that we, to a certain extent, are insulated from a lot of those fears, the macros back home don't look as precarious as they do overseas. Do you think that the view, the FII view, the HNI view then on India is likely to change?
So if you look at, I always say that India macro is in a very, very good situation, both on absolute basis on as well as relative basis. Maybe in my last 30 years of my career, I have not seen such a sweet spot on relative basis particularly. So great opportunity. See, the challenges is not in India. If there is any events unfold can only happen on the global market. If you look at the employed world, so the global asset class has been relatively low. So a lot of people expect some amount of sticky walls which is there can explode. That could be phenomena which can play out. But what can lead to it? Either it can lead to some geopolitical situation, okay, or in the Middle East area, or it can be something related to currency because the consensus is now building towards de-dollarization and the collapse of dollar. Maybe that can reverse. So we don't know what exactly can play out. But if I look at purely from a predictive analytics point of view, we are on the cusp of that inflection point where employed walls can spike. And we have been very vocal about that employed walls will remain elevated between 2018 till 2023. And this is the culmination year of that. So we are also not ruling out any spike which can happen, but it's not going to happen any event which will play out in India. Answer is big no. Anything can play out globally. If it plays out, that could be a short-term impact, maybe few weeks impact. But that is the area one has to go all out and participate in Indian equity because there is no problem out here. So if you get any opportunity because of any global events, I think we will be very aggressive in recommending to go aggressively long. So we will look for opportunity to buy. And I agree with you, there is no problem in India. The concern remains globally. And we are very watchful and observing these data points, how it's unfolds. Let's take a call when it unfolds.
Especially given with what's happening in our neighboring country as well, we're pretty much at a very, very precarious stage right now. But Sandeep, have to ask you about L&T. The operational numbers are pretty much okay and in line, but purely their commentary on execution for the full year ahead and thereby the guidance that they posted, what are you making of it?
See, the way I will define this question is that if you really look at, in last 1 year, what has played out is about reverse ESG call or anti-ESG call. All these names which has beaten down significantly has come back with a vengeance actually. So obviously, they have rallied a lot. Any small disappointment can lead to a sharp correction. As I just explained in the market, the impact costs are relatively high. But I think we remain very constructive on the capital goods stocks from a longer term perspective. And I think L&T being a leader, generally we don't comment on the stock. Okay, being a leader should be a good opportunity if somebody has a longer term perspective. Okay, we remain very constructive on the capital goods space, and we like to identify all the companies which has scale and has potential to deliver the projects on time. And some of these names qualify for that. So I think sometime when you do get such opportunity, one should look for buying rather than getting exited at the lower levels.
Sandeep, we let you go on that note. Thank you so much for joining us. Quite positive about the Capex story. But for